You're listening to Uranium Spotlight, brought to you by Purepoint Uranium Group, your exploration partner in the most prolific areas of Canada's Athabasca Basin. With a collaborative investment model on district-scale projects and validation from industry leaders Cameco, Orano, and IsoEnergy, Purepoint is investing in Canada's uranium future.
And now your host, Chris Frostad.
It's Tuesday, October 14th, 2025, and this week on Uranium Spotlight, spot cools as fund flows ease. Japan returns to the uranium market, India unveils its 100 gigawatt nuclear expansion plan, and IsoEnergy expands its global footprint with the acquisition of Toro Energy. The uranium spot price opened last week at $81 a pound U3O8 and closed at $79.20, marking a modest pullback after several steady weeks. The shift was less about fundamentals than fund flows. Sprott Asset Management, operator of the world's largest physical uranium trust, noted that recent weakness reflects quieter activity from financial vehicles that had been driving much of the buying this year. In its latest commentary, Sprott emphasized that the uranium market remains fundamentally strong. It attributed the slowdown to normal rebalancing rather than fading momentum. Supply constraints continue to dominate the picture, with Cameco and Kazatomprom both producing below guidance due to weather, operational delays, and deliberate restraint. Smaller players like Paladin also revised production forecasts lower after heavy rains disrupted mining in Namibia. Sprott believes these production shortfalls, combined with the slow timelines for new mines, such as NextGen's Rook I, will keep the market structurally tight. The trust's view is that last week's dip in spot represents a pause rather than a reversal. The long-term contract market never weakened and continues to rise gradually above $80. For investors, the key takeaway is that short-term spot volatility is being driven by fund flows, not fundamentals. Supply discipline and limited new mine capacity remain bullish forces. If you haven't already, be sure to subscribe to Uranium Spotlight podcast, available on your favorite podcast platform or on Purepoint Uranium's YouTube channel. After more than a decade of relying on stored material, Japan Nuclear Fuel has resumed buying uranium. The facility that produces nuclear fuel for the country's reactors has been idle since the Fukushima shutdown in 2011. And only restarted in 2023 when reactor restarts began to accelerate. Until now, it had been drawing entirely from pre-Fukushima stockpiles. Last week's delivery marked Japan's first inbound uranium shipment in 11 years, a small event in volume terms, but a major signal to the market. It suggests that strategic reserves across Western-aligned nations are beginning to thin. According to recent data from Europe's Euratom supply agency, most European utilities now hold only about 1 year's supply of uranium. The U.S. is slightly better positioned with roughly 2 years of inventory, but that remains historically low. By contrast, China, Russia, and India each hold multi-year reserves and are actively adding to them. Japan's move therefore serves as a leading indicator. It may foreshadow a coming wave of restocking from Western utilities that has delayed long-term procurement. With prices firming around the fuel cycle and production slow to expand, utilities that wait too long could face sharply higher prices later this decade. Japan's resumed activity also underscores how quickly latent demand can re-enter the market once reactor fleets return to service. The country currently has 12 reactors operating, 9 approved for restart, and 16 applications pending. Each restart compounds annual uranium requirements and reduces available mobile inventory in a market already running thin. The bigger implication is psychological. Japan's cautious utilities are known for moving only when absolutely necessary. Their re-entry signals a shift from reliance on stockpiles to active procurement, a turning point that often precedes broader buying cycles. For investors, this matters because Japan's action hints at a structural drawdown of Western inventories. As utilities re-engage, fresh contracting could accelerate price appreciation and tighten the market well before new mines can respond. India's Ministry of Power has approved an ambitious roadmap to reach 100 gigawatts of nuclear generation capacity by 2047, roughly equivalent to 100 large-scale reactors. The plan, confirmed by a government panel and its technical agency, outlines a sweeping expansion of uranium supply chains, reactor construction, and fuel management. The recommendations are wide-ranging. India intends to accelerate reactor builds and extend operating lifespans to 60 years, expand domestic uranium mining and open exploration to private firms, acquire and develop uranium assets overseas, stockpile sufficient uranium to cover full reactor lifetimes, increase reprocessing capacity to recover fuel from spent material. This framework effectively positions India as both a massive consumer and a significant future participant in global uranium supply. The country currently operates 23 reactors, totaling about 7 gigawatts, with another 9 under construction. Reaching 100 gigawatts would require over 10 times today's fuel consumption. The short-term challenge is sourcing that fuel. India's domestic mines are limited, and the build-out of new operations typically takes 10 to 15 years. Even if India acquires stakes in mines abroad, those projects may not contribute in time to feed the next generation of reactors scheduled for commissioning in the 2030s. This means Indian buyers will likely compete aggressively in the open market for the next decade, adding substantial demand to an already tight environment. India's state-owned enterprises are expected to sign long-term offtake agreements and invest in overseas projects across Africa, Central Asia, and Australia, following a path similar to China over the past 15 years. The geopolitical implications are also important. As India's nuclear program scales, its need for assured fuel supply will draw it closer to Western producers and technology partners. That could shift procurement patterns away from Russian conversion and enrichment channels and toward Western suppliers, tightening available uranium in the West. For investors, this matters because India's 100 gigawatt plan adds one of the largest incremental sources of demand on the planet. With mine development timelines stretching over a decade, new supply will struggle to keep pace. The result is likely to be a multi-year support for high uranium prices and an expanding opportunity set for explorers and developers globally. IsoEnergy announced last week that it will acquire Australian-listed Toro Energy in an all-share transaction valued at $75 million Australian. The deal brings Toro's 100% owned Wiluna uranium project in Western Australia into IsoEnergy's portfolio, which already includes the high-grade Hurricane deposit in Canada's Athabasca Basin and past-producing mines in the United States. Under the agreement, Toro shareholders will receive 0.036 IsoEnergy shares for each Toro share, representing a 79.7% premium to Toro's last traded price. Upon completion expected in the first half of 2026, Toro shareholders will own about 7% of the combined company. The acquisition materially expands IsoEnergy's development pipeline, creating a diversified uranium platform across 3 of the world's top jurisdictions: Canada, the U.S., and Australia. Wiluna, which holds several deposits totaling over 100 million pounds of historical and current resources, provides a long-life scoping-level project that can advance rapidly once Western Australia clarifies uranium mining policy. IsoEnergy CEO Philip Williams called the move a major step towards building a globally diversified, development-ready uranium platform. For Toro, the transaction offers greater liquidity, stronger financial backing, and entry into North American markets. For investors, the key takeaway is this: IsoEnergy's acquisition of Toro consolidates high-quality resources at a time when scale and jurisdictional diversity are increasingly valued. It enhances IsoEnergy's leverage to future price gains and positions the company among the most advanced global uranium developers. And that wraps up your Uranium Spotlight coverage for this week. For more news and events from the world of uranium, please tune in next week to Uranium Spotlight.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to delivering the latest news and events shaping the uranium fuel market and its critical role in the global energy landscape. Brought to you by Purepoint Uranium Group. Purepoint actively operates a portfolio of advanced uranium projects in the world's richest uranium district and has established partnerships with industry leaders. While our passion for this subject is undeniable, it's essential to clarify that the information presented here is not investment advice. Instead, our goal is to offer an unbiased and comprehensive review of recent events that could impact uranium prices. Join us again next Tuesday for Uranium Spotlight.